There is a lot to love about index investing. It's simple, the costs are low, and you need to spend less time managing them. And all this with reasonably good returns. But it comes with two significant challenges. First, the maximum you can earn is what index and in effect the markets deliver. And second, your portfolio will fall as much as the markets. So the question arises, can you invest in index funds and yet get better returns than markets and control the downside? The answer is yes, thanks to factor investing. Hello and welcome to ED Money's YouTube channel. Today, we will talk about factor investing and how it can make a difference in the performance of a passive portfolio. Now, factor investing may look like a new concept, but it's not, as we will discuss this shortly. We will also see if there are any factor indices that come out on top and are worth adding to your portfolio. So watch this video until the end to get the most out of it. But before we start, an important update. The tax saving season is going on. And the ET Money app and website provide you all major tax saving options, LSS funds, NPS, life and health insurance in one place. You can invest without any paperwork and get instant proofs. Alright, back to the video. Let's begin with a short introduction to factor investing. Factor investing is choosing investments based on specific criteria that are known to impact portfolio performance. Now, this performance we're talking about doesn't necessarily have to be returns. It can be better diversification or less volatility or something else as well. Now, some of the most famous factors are quality, value, size, momentum, and low volatility. Now, the names of these factors give you an indication of what they do. For instance, the quality factor seeks to pick investments based on specific quality criteria. The size factor selects securities based on certain size and so on. Now, factors need not be only related to style of investing. They can also be related to economic criteria such as inflation rate, GDP growth, industrial production, etc. Now, a typical application of factors in investing is smart beta. Smart beta means the construction of indices based on one or more factors. Now, indices tend to be based on market capitalization and free float. Smart beta investing changes that orientation by infusing certain factors into the index construction. In a way, it combines active and passive investing approaches. Let me give an example. You must have all be aware of Nifty50. It's among the most popular indices that track the largest and most liquid Indian companies. Now, when certain value criteria were applied to the Nifty50 and 20 stocks were picked from it, the Nifty50 Value 20 index was obtained. It's a factor or smart beta index. Another example is the Nifty200 Quality 30 index. It selects 30 quality stocks from the broader Nifty200 basket of stocks based on certain criteria. Now, factor investing picks stocks as per preset criteria. So, factor indices are very much passive instruments as well. In many cases, you can call them modified versions of more mainstream indices. Now, these modified indices are meant to do better than their parent indices in terms of returns or diversification or volatility, etc. But does it really happen? Are factor indices always better than their parents or the closest mainstream peers? That's what we will try to find out now. And in the process, we will tell you the best factor indices out there, so keep watching. But before I proceed, let me request you to subscribe to this channel if you aren't already a subscriber. And don't forget to click on the bell icon so that you never miss a video from us. There are as many as 35 factor indices mentioned on the NSE's website. However, not all of them are useful from an investment perspective. That's because many of them are not investable. That is, no funds are available for them, the trading volumes are inadequate, or there isn't sufficient history and data which makes their analysis difficult. Now, there are just 7 indices that make the cut. You can find their names on the screen. We will talk about the winners in greater details later. For now, let me give you a quick overview of these 7 indices. The Nifty Alpha 50 index picks 50 stocks from the top 300 companies by free float market cap based on their alpha or outperformance. The Nifty Alpha Low Volatility 30 index picks 30 stocks from the Nifty100 and Nifty Midcap 50 based on their alpha and volatility. The Nifty50 Value 20 picks 20 value stocks from the Nifty50. The Nifty100 Low Volatility 30 index picks 30 low volatility stocks from Nifty100. The Nifty100 Quality 30 is on similar lines, but it picks 30 quality stocks. Finally, the Nifty100 equal weight and Nifty50 equal weight indices have the same components as the Nifty100 and the Nifty50, but they are equally weighted. So all the stocks carry the exact weights, unlike their parents, which have more weights assigned to the larger and more liquid stocks. Let's now analyze these 7 indices and find out the best among them. Let's first talk about returns. We will use a metric called average rolling returns here. It is obtained by averaging all instances of returns for a certain period. For example, if it's average 5-year rolling returns, we will average all instances of 5-year returns over a period span. That's what makes rolling returns a comprehensive and reliable metric for the returns picture. Alright, let's consider the average 5-year rolling returns of the 7-factor indices and their benchmark and parents. For the Nifty Alpha 50 and the Nifty Alpha Low Volatility, there isn't an obvious parent. But because these two indices take exposure to large and mid caps, let's use the closest available option, the Nifty Large Mid Cap 250 Index. We recently did a video on the Nifty Large Mid Cap 250 Index. It's a promising index that allocates 50% each to large and mid caps. So do watch that video as well after this one. I've included the link in the description. Okay, so 4 out of 7 indices beat their benchmark. These are Nifty Alpha 50, Nifty Alpha Low Volatility 30, Nifty50 Value 20 and Nifty100 Low Volatility 30. 3-factor indices failed to beat their parents, Nifty100 Quality 30, Nifty100 Equal Weight and Nifty50 Equal Weight. But returns alone are just half the picture. Let's assess the volatility of these returns as well. To do so, we will measure the standard deviation of these average 5-year rolling returns. The higher the standard deviation, the more the volatility. Just one factor index, Nifty100 Low Volatility 30, does better than its parent. The Nifty100 Low Volatility 30 also had a better return profile than its parent. So both in terms of return and volatility, it is the better option. But to get more accurate picture, let's assess the risk-adjusted performance of these factor indices against their benchmark and parents. And to do so, let's divide the average 5-year rolling returns by the volatility or standard deviation of these rolling returns. Now, risk-adjusted performance helps us understand if the returns are commensurate with the risk of the volatility involved. The factor indices that fail to make their mark are the Nifty100 Quality 30, Nifty100 Equal Weight and Nifty50 Equal Weight. They have lower returns but higher volatility, as their risk-adjusted performance is poor. Now, if you observe the gap between the risk-adjusted performance of these indices and that of their parents, that's quite wide as well, ranging from 11% to 35%. Of the remaining 4 indices, the low volatility ones do the best job, particularly the Nifty100 Low Volatility 100 Index. Its risk-adjusted performance is 19% better than its parents. The Nifty Alpha 50 and Nifty50 Value 20 also do a decent job. While they lag behind their parents in terms of the risk-adjusted performance, the gap isn't too wide. It's almost nil for the Nifty Alpha 50 Index. So by taking slightly higher risk, one can profit from higher returns in the case of both these indices. Now, if we rank them in terms of their risk-adjusted performance versus their parents, the order would be Nifty100 Low Volatility 30, Nifty Alpha Low Volatility 30, Nifty Alpha 50 and Nifty50 Value 20. Alright, now let's talk about these 4 indices so that you can pick the most appropriate one for yourself. Let's begin with the Nifty100 Low Volatility 30 Index. This index is derived from the Nifty100 basket of stocks, which are all large caps. So the Nifty100 Low Volatility 30 picks 30 less volatile stocks from these 100 stocks. Its average 5-year rolling returns and their volatility are better than the Nifty100 group of stocks. So is its risk-adjusted performance. So it's definitely a better option than the Nifty100. This means if you want to take exposure to large caps, going with this index can be quite rewarding and less bumpy. What can be better than that? Next comes the Nifty Alpha Low Volatility 30 Index. It's a multi-factor index as it combines 2 factors, alpha and low volatility. It gives 50% weightage to each of those factors. Now, alpha stands for outperformance over the market or a benchmark. So this index seeks to pick stocks that are doing well and are less volatile too. This index picks stocks from the Nifty100 and the Nifty Midcap 50 indices. So it has a midcap tint as well. In terms of returns, this index is more rewarding than the Nifty Large Midcap 250 index, but it's more volatile too. Now, in risk-adjusted terms, it does compensate well for the extra volatility one may have to tolerate. So if you'd like to have a large and mid cap exposure within a single fund, this index could be a good option for you. However, do note that unlike the Nifty large mid cap 250 index, it doesn't have a defined exposure to large and mid caps. So it's likely that this index will be large cap tilted, as it was in December 22 and December 2023. Next comes the Nifty Alpha 50 index. This index picks 50 stocks from the top 300 stocks by market capitalization. So its investment universe is quite large. This index is also based on alpha or outperformance. It has quite a wide outperformance over the Nifty large mid cap 250 index. The volatility is much higher as well, but it does compensate well for the risk taken as seen in its risk adjusted returns. So this index is meant for those who would like to take exposure to both large and mid caps within one index and are also willing to take higher risk for the higher returns. In other words, this one is for more venturesome investors. Now, as of December 2023, this index had 43.45% allocation to mid caps, 28.8% allocation to small caps, and 27.19% allocation to large caps. Now, this high allocation to mid and small caps is a primary reason for its massive outperformance. But do know that it need not always have high allocation to mid and small caps. If it finds alpha in large caps would command a higher share in it. So it can even act as an alternative to flexi-cap funds. Finally comes the Nifty50 Value 20 index. It picks 20 value stocks from the Nifty50 index. Now to assess value, it uses metrics like the price to earnings ratio, the price to book ratio, dividend yield, and return on capital employed. Now you can Google these terms to know more about them if needed. But if you don't want to get into its technicalities, that's fine. All you need to know is that it is a value-based index. It has delivered better average returns than the Nifty 50, but is also more volatile. However, it compensates well for the extra risk taken as in its risk-adjusted performance. Its significance lies in the fact that it is based on a clear definition of value, unlike active value and contra funds. Active value and contra funds define value both in a subjective and objective manner. This often results in their holdings looking like those of vanilla flexi-cap funds. That's not the case with this index. You can be rest assured that you are getting a value exposure throughout it at all times as per the index methodology. So if you're interested in a value fund, don't ignore this one. Last but not the least, on your screen, you can find the list of all the funds based on these 4 indices. You can invest in them on the ET Money app without paying any commission. And that's what we had for you today. Hope you found it useful. And if you did, don't forget to share it with your friends and family. And I'll be back soon with another video. Till then, take care.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.